What's up, everybody? Welcome to Heresy Financial. My name is Joseph Brown, and it looks like the carnage is not yet done. Over the past couple of weeks, we've seen literally the fastest decline in the stock markets in history. That includes 2008, that includes 1987 Black Monday. It also includes the Great Depression, the stock market crash in October of 1929. What we are witnessing right now is absolutely, number one, unprecedented, and number two, it will go down in history as one of the biggest, if not the biggest, financial events, not only of our lifetimes, but probably in all of history for the United States of America. Let's dive in. I'm recording this video on Thursday, March 12th. There's about 1.5 hours before the market closes. So if you're watching this tonight or tomorrow or at some point in the future here, just keep in mind, obviously we don't know what's going to happen here. So a lot can change very quickly, especially in these market conditions. But as of right now here, the S&P 500, we're sitting down just under 8%. The Dow Jones Industrial Average, we're currently sitting at just about 8.5% down. And the Russell 2000, we're almost 10% down. Now, I've talked about this in the last couple of videos here, but take a look at this. Take a look at this chart, Russell 2000. If you would have bought the Russell 2000 anytime since the beginning of 2014, right here, there are maybe a couple of weeks, a couple of months where you could have bought it and still be sitting at a gain. Apart from that, if you would have bought United States of America small companies anytime in the last 6 years, apart from those few weeks and months where it had a little dip, you'd currently be sitting at a loss. Now, the larger companies that are in the index is the S&P 500, for instance. That date you're going to be looking at somewhere in 2017 right here. Let's zoom in a little bit. So we're currently sitting right about here in terms of where the price is today. And so that would have been right about September of 2017. If you would have bought, the only time between then and now that you could have bought and still been at a gain was the end of 2018 when the markets were selling off pretty hard. And let's be honest, not a lot of people were buying then. And so especially, and nobody just buys the market, one and done and just lets it ride. Most people are dollar cost averaging. You're buying the markets, with your 401k contributions, every 2 weeks as your paychecks come in, whatever the case may be. We've basically erased the last 3 years of stock market gains in a period of time of just a couple of weeks. Now, if you're not familiar with the VIX is it's oftentimes called the fear index, and basically it's calculated by looking at the money options on the market. And so when fear escalates and fear is growing in the markets, people are buying options, institutions are buying options, puts, calls, and hedging basically. And you can see that every time that there's a market panic, this thing spikes. We had a spike during, 2008. We had, a spike during 2010. We've got, a couple big spikes along here. We are sitting at the largest spike in the VIX right now since 2008. We can see here that there's a lot of panic selling and hedging and speculation going on in the markets right now, which makes sense given the amount and the speed at which the markets are currently selling off. Now, if you've been around my channel at all up to this point, you know that I've been advocating for buying gold for a very long time. And I want to take a moment to show you and kind of explain why, just to build confidence in what's been happening recently, because we've seen some selling in gold as well. But take a look. The S&P 500 since the beginning of 2018 here, we've erased all those gains. If you would have been investing in gold that entire time, look at how much you're still up. If you would have been investing in primarily small companies, the Russell 2000, we're looking at gains being erased all the way back to 2014. And so if we look at what gold has done since 2014, Again, that's right about here. So you had the opportunity, if you had been dollar cost averaging into gold all along through here, basically buying it virtually at a very steady price all throughout this range, and you're sitting on some massive gains in gold right now. Gold, just like any other asset, will get sold off in liquidity crunches. And I've said this before, but in 2008, gold was down about 30% from the top to the bottom during that year. But then it went on to experience about a 260% gain from the bottom to the next top. And so in liquidity crunches, when margin calls are happening, when credit is drying up, everything gets sold. And that includes gold. But there's a clear difference between gold being down 3.5% today right now versus, the Russell 2000 being down 10%, the S&P 500 being down 8%, the Dow being down 8%. There's a big difference in that, especially when you watch over the last couple of weeks how that's unfolded. We're basically sitting in a very tight channel here, and we've continually bounced off of this support level in gold, which matches up pretty nicely with the historical support. Last time we got up above this price level, it was back in here, and right now we're sitting at that exact same level here. We're staying in that new higher range. And so the reason it's not for capital appreciation, and I've explained this before in past videos, but I'll dive into it right now just as a refresher. You're not going to make money with gold. The value of gold really doesn't change over time. When you measure the price action of gold over long periods of time, the correlation is pretty much exactly an inverse of the quantity of the money in which you're measuring it in. So when you measure it in dollars, the price performance of gold is basically equal to real inflation over a long period of time. And that's because the value of gold doesn't change. And so when the price of gold is going up over a long period of time, the only thing that's doing is that's reflecting how much purchasing power the money you're measuring it in is actually losing. Gold can never actually go to zero because the value of gold will, at the very minimum, always be tied to the amount of labor and the price of labor that it takes to produce more of it and take it out of the ground, basically. And you're never going to make tons of money just by sitting on gold because its value doesn't really fluctuate. It doesn't produce earnings, it doesn't produce income. And so I've said this before, but gold is not an investment, gold is money. It's been that way for thousands of years. And so that's why gold is the ultimate safe haven, because it's nobody else's liability. There's no counterparty risk when you hold gold yourself. It's just an asset. It's just something that maintains its intrinsic value throughout history, throughout cultures, throughout economies, all throughout time. And so when things get rough and you can see economic conditions deteriorating, gold is the ultimate safe haven asset. It's what you buy so that you don't lose your value. It's so that you preserve your purchasing power. It's so that when the S&P 500 erases 2 years of gains in a matter of a few weeks, and the Russell 2000 erases 6 years of gains within the matter of a few weeks, you don't lose your purchasing power. You maintain your purchasing power because you've seen governments engaging in the most irresponsible fiscal and monetary behavior that we've ever seen in history. The amount of stimulus and money printing and debt that has just been unleashed into the global financial markets in even just the last few years, something like this could have been predicted by anybody who is watching. And so you go to gold so that your purchasing power isn't wiped out. You're not going to make money from the gold itself, but you're going to preserve your purchasing power. And then once things are on sale, you have the money to actually do something with it. You can buy it. You're not trapped in something that is going to take you years and years and years, potentially decades, to make your money back on again. Okay, now one other note on gold before we move into more of a discussion on the financial irresponsibility and the responses that are now necessary by the central banks in order to deal with the fallout of those choices. Right now, I've been seeing reports from some people who are kind of inside the industry, from the bullion banks, that essentially, I've talked about this in the last couple of videos. Every time gold gets up to about $1,700 an ounce, there's a severe sell-off, right? And it looks like there's a bunch of naked shorts being poured onto the market. Looks like there's not enough physical gold by these bullion banks to cover physical delivery. As the price of gold starts going up, the physical delivery starts being requested more and more, and so it looks like they're trying to artificially suppress that price of gold here, so that they don't get into this situation where they start having a run on their bank and a run on gold, and they don't start going out of business and dropping like flies. One of the things that we're seeing, though, that they're doing is they're starting to cover those shorts. And they're starting to, it looks like they're trying to build their positions so that when they're covering their shorts, they're basically flipping now. And so this is a consolidation phase here, really, for gold, is what it looks like. And this next phase, as the bullion banks, if they're able to, make this turn before the price of gold hits at a point at which they will start having to shut their doors. It looks like, central banks have been bullish on gold for years. That's why they've been stockpiling at all the central banks around the world. But it looks like now everybody else, the institutions, the establishments, are starting to get on board with that, trying to suppress the price, dump it down so they can build up their physical positions as well. So it looks like that's what's happening with the price of gold. I don't know how much longer this consolidation phase will continue to go before ultimately there's no more of that naked short dumping onto the market, but we'll see. And it looks like the tide is starting to turn now. And so I've been saying this for weeks now. All of these dumps in gold are massive buying opportunities. And just so you know, if you go back and watch any of my videos, I've never said that about stocks. If you go back and look at all my videos, I've never said that, hey, this S&P 500 drop right here, this is a buying opportunity. I've never said buy the dip in the Russell 2000 or the S&P 500 or the Dow. So it looks like gold. And if you want to speculate, gold miners, it looks like, with oil down, the production costs going down, gold price about to skyrocket. They're going to, the opportunity to make a ton of money is in the miners. Just make sure you're picking gold mining stocks that are flush with cash. You don't want to pick stocks that are heavily reliant on debt, because credit is drying up right now. You don't want to pick companies that are loaded up with a ton of debt, and companies that are sitting on good deposits, proven deposits, not ones that are just doing exploration and hoping to land a big mine. So pick a good miner, and the opportunity for a big gain is huge right now. It's I think that gold mining stocks are probably going to be the buy of the decade. Okay, so that's my 2 cents on gold here. Now I want to shift over into debt. So I've got a chart up here right now. This is TLT. This is an ETF that tracks treasuries. The first thing that happened in the bond market was a collapse in junk bonds. Let's throw that up. JNK, that is an ETF that tracks, it just has junk bonds in it. All right, this is a chart since about 2008, and you can see that ever since about 2010, we've had this it was kind of stable up here, and then during 2016, it sold off a lot. But pretty much since the election, our junk bonds, they've been, it's been pretty consistent, and they've been very high yielding. And so, but now, as of just the last couple of weeks, we've seen this massive collapse in junk bonds. Now, that's the first place this shows up, because ultimately what's been happening over the last couple of years, as monetary policy has been extremely easy, you've seen a ton of money that has been flooding into the banks, and the banks need to do something with it, because they can't just continue to loan at the same amount of dollars that they've always been loaning at, historically, because the spread is smaller. They need to make up in quantity what they are losing in the actual interest rate on that debt, on that money that they're loaning out, in order to make the same amount of money. So as interest rates have been low, debt has been really easy. So banks have been needing to make up for that loss in interest on each dollar by loaning out more dollars. So there's been a ton of money thrown at garbage companies. That's why we've seen some of these massive blowups in the IPO space, massive blowups in private equity. Everybody remembers the story about WeWork, and so you've seen a lot of easy money coming into these companies that don't have financially sound business plans. They don't have, we had more money losing IPOs in 2019 than we did in the dot-com bubble back in 99. We had more money losing companies just overall in the S&P 500 since then as well. And so you've had a ton of easy, cheap money coming in, financing companies that otherwise in a free market without manipulation and without intervention would not have had any sort of sustainable business model. They would have been crushed. They would have gone out of business, or at least had to restructure and do things very differently. And so we've seen a lot of money go into these garbage companies. Well, what's the first thing that goes when money then starts to get tighter? Well, it's these garbage companies. They're the first ones. They're the ones that pay in the higher interest rates. They're the first ones to stop getting that money loaned to them when money conditions get tighter. So they're the first ones that start to go under. So we're going to see a lot more bankruptcies and a lot more closures start to happen across these garbage, debt-loaded up companies that were only able to survive because they were getting the cheapest money just handed to them, and they were just surviving off of continually rolling over that debt. It's like you max out one credit card, then you go on to open up a new credit card, just transfer the balance, load it up a little bit more. They were continuing this over and over again. So that's the first thing to go, and that's going right now. The next thing to go is investment grade. Now, this is a chart of an ETF that invests in investment grade bonds, and it's LQD. It's currently down just a little over 4% here, but you can see that's a pretty massive drop, and that's the next thing to go because just like happened 10 years ago, the rating companies have been assigning much higher grades of ratings to these bonds than are actually, it's much higher than they deserve because they're companies that again are surviving based off of rolling over their debt. And like I said, even in the S&P 500, there's more money losing companies surviving off of this easy debt than there has been since the dot-com bubble. And so these are the next companies to start to go as money conditions get tighter, as banks don't have the ability to lend. This is the next kind of domino that gets pushed over. And I really want you to understand the significance of this because the coronavirus by itself, if we had a healthy financial system and healthy companies and a global economic system that wasn't built on mountains of easy debt and fiat currency and monetary stimulus and just the most financially irresponsible policies and actions that have ever happened in the history of our world, the coronavirus would be something that we could handle. We'd have investments built on savings. We'd have piles of savings we could rely on as a country, as companies, as individuals. We wouldn't have a system built on mountains of debt that crumbles the moment debt is no longer available. And so these companies, even investment grade bonds, they're starting to plummet. They're starting to crater because liquidity and credit is drying up. And one of the reasons that liquidity and credit is drying up is the Fed. It's the federal government, and it's the interest rates. This might need its own video to kind of explain and go into further, but essentially as interest rates go down, that flattens the curve. And so all interest rates kind of get pushed down. And so if the Federal Reserve, let's say, were to go under zero, were to go negative, that would pretty much completely flatten the curve. And banks wouldn't have the ability then to loan out dollars against their reserves at a rate that was profitable. So the spread kind of disappears if that yield curve goes flat. And so you see companies you just see companies not able to get money anymore because the profitability, the ability for banks to lend money just goes away. There's no profit opportunity there. There's no ability for them to loan money at a rate that is going to make them money. So banks can't do that anymore. So banks and financial institutions, the plumbing of our system starts to crack, starts to break, and starts to topple. So the Federal Reserve has, on one hand, this massive problem where they can't let rates go too low. And so in order to prevent rates from going too low, you'd have to let debt sell off, because as debt gets sold off, rates go up. But on the other hand, they have this massive problem where they can't let rates go too high, because if rates go too high, then the federal government goes bust. The federal government defaults, because the only way the federal government is able to continue to operate is purely on debt. Taxes are diminishing at an insane pace right now. Payroll taxes are getting cut. Economic activity is just getting crushed across the globe. And so you have tax receipts and revenue is about to just plummet. And so the only way that they can continue to operate is to issue treasuries. Well, if treasuries start to get sold off, the free market would start to sell off these treasuries, because, they're worthless. The tax receipts, the interest rate, the inflation is going to go up. So the interest rate that you need to compensate yourself for loaning that money for that period of time, you need a lot higher interest rate. And so free market would send the yields on treasuries up by selling off those treasuries to a lower price. But the federal government would default if that happened. They would not be able to roll over their existing debt, let alone service. They wouldn't be able to service their existing debt, let alone roll it over. And let alone compensate for the additional expenditures that they're going to have from all of this helicopter money, these bailouts that are about to start taking place, to compensate for the tax receipts going down, the tax revenue going down. So expenditures from the federal government are about to explode. And so the Federal Reserve cannot allow yields on treasuries to spike, because federal government goes bust. So they're having to play this game right now where they're every point along the curve, they are having to buy and sell and manipulate the curve in order to try and keep rates all along the curve exactly where they need and want them. And so they're playing a game right now where it's almost impossible to win. And so one of the things that we've seen over the last few days is the spread on treasuries has really been faked. It's been non-existent. Insiders, people who are in the know, traders of treasuries and bonds, they're saying, hey, yes, there's a tight bid and ask on treasuries. There's a tight spread, but it's not real. They're not actually being filled. And so in order to get filled, they have to go way outside the spread. And so you're seeing a massive liquidity crunch on treasuries that if you want to sell your treasuries, it's very difficult to right now. There's no bid. And so that's part of the reason why the Federal Reserve today had to announce their basically $1 trillion bailout package. It's not really bailout package, it's for the repo markets, but essentially they're just, of all of the problems that are just compounding, there's over the last 10 years, you have to manipulate more and more in order to keep up what you've built. We have a house of cards that's starting to crumble. It's held together by scotch tape and chewing gum. And as it starts to crumble, the only thing they can do is to pile more cards in there. As the bubble starts to deflate, they're trying to blow more and more air into the balloon to keep it inflated. And that is the meaning of pushing on a string. Monetary policy is no longer effective. After this $1 trillion stimulus that they announced today, look at this. The S&P 500 down over 8% now. It's just, continuing to sell off. We're at the bottoms again today, and we've got about an hour now before the market closes. We'll see what happens through the end of the day. But every stimulus, every package that's been announced since the Trump's press conference last night, everything that they've done over the last couple of weeks has been useless. The markets have continued to sell off, and the carnage in the bond market and treasuries is really what's going to take out the system. And the only reason why their emergency responses worked 2008, 2009 in order to kind of rescue the system is because the entire world believed the United States that it was an emergency measure and they would unwind it. That the Federal Reserve would unwind those trillions of dollars on their balance sheet and get back to normal. That's what they told everybody. That's what everybody believed. And they couldn't do it for years. And the moment they tried it, it started to collapse the markets. They didn't have the ability to, so they started to build up their balance sheet once again. And the world's not going to take it this time. The world's not having any of it. We're already seeing over the last couple of years, the world has been dumping treasuries like crazy. The Federal Reserve is the only buyer of treasuries now. Everybody's getting out of them. And as treasuries and as dollars come home, inflation will skyrocket. Price inflation. monetary inflation is going absolutely off the chain. It's going to be absolutely unbelievable the amount of money that's going to be printed over the next couple of weeks, couple of months, couple of years. And ultimately, we're in for a collapse of the United States dollar, and it's no longer going to be the reserve currency of the world. So, right now, I'm heavy in gold because that's the safe haven, and in times of insolvency, gold shines. And as soon as companies start showing up as being on sale, as soon as stocks start looking like they're cheap again, as soon as companies that don't have a lot of debt, that don't need the bailout packages, as soon as we start seeing a bunch of bankruptcies go across the board, as soon as we start seeing these bailout packages being unrolled, as soon as we start seeing a lot of this start to happen, then I think we'll start to see a bottom in things. Then I'll start to see companies and stocks on sale, and I'll start to be able to say, hey, I'm going to take some of my dry powder now. Since I've been in gold this whole time, I haven't seen some of these massive collapses. I've preserved my purchasing power, and that's why fortunes are built during bear markets, because when everything collapses, it's the people who have the dry powder who are able to buy the things at steep discounts as everybody else is forced to sell because they were the ones that were steeped in debt. They were the ones that were collapsing, that needed that liquidity, and they had to sell at any price necessary. And so the people who are able to have dry powder and purchasing power throughout the bad times, they're the ones that get the deals when everything is at the bottom. Be patient. The buying opportunities will come. In the worst of times, everybody experiences pain. So you're going to see some selling. You're going to see some down, even if you're in gold. Make sure you're not just following the masses off the cliff right now. Thanks for watching. I really appreciate it, guys. Hit that like button. It really helps out the channel, helps the YouTube algorithms push the video in front of other viewers so that more and more people can prepare, because it's still not too late. We've still got a lot of carnage left to come. We are nowhere near the bottom yet. Really appreciate you guys. Stay safe. Have a good day.